Imagine this. A tribunal in Geneva has found that a landmark U.S. Climate Policy Act, the one touted as the largest clean energy investment in American history, runs afoul of global trade rules. A panel of lawyers, not policymakers in Washington or Beijing, concluded that tax credits and incentives designed to accelerate renewable power and electric vehicles discriminate against imported products and ought to be withdrawn. This decision, in a dispute brought by China under the World Trade Organization's WTO subsidy disciplines, sits at the intersection of climate ambitions, industrial strategy, and the architecture of the rules-based trading system. For most observers, this looks like a familiar clash between economic giants. But beneath the headlines lies a far deeper structural tension, one rooted in how industrial subsidies evolved after the Uruguay round, how the WTO's institutional machinery enforces or fails to enforce its own disciplines, and how global clean energy competition is reshaping trade law itself. What follows is an exploration of the hidden systems shaping this moment, the accumulation, entrenchment, and leverage of industrial subsidies, the metaphorical arteries and choke points of global trade governance, and the quieter consequences that ripple across supply chains, policy spaces, and international institutional frameworks. Most people assume that trade rules are neutral technical constraints, like traffic signs on a highway. In this view, countries set their industrial policies and then step carefully to avoid collisions with WTO commitments. This framing feels logical because most public debate simplifies the conflict to a choice. Should we subsidize renewables or respect trade rules? But this framing obscures the deeper architecture. The WTO does not stand above markets as a neutral referee. It is a constructed network of legal disciplines, enforcement mechanisms, and procedural pathways whose effectiveness depends on member states' engagement and mutual recognition of shared constraints. For 4 decades after the General Agreement on Tariffs and Trade, GATT, expanded in the late 20th century, subsidy disciplines were relatively modest compared with rules on tariffs. The Subsidies and Countervailing Measures (SCM) agreement, enshrined with the WTO's establishment in 1995, divided subsidies into 3 metaphorical colors: red light, prohibited, such as export and import substitution subsidies; yellow light, actionable if they cause adverse effects; and green light, non-specific and non-actionable, a traffic light system intended to guide state conduct. Yet, as states industrialized, poured capital into strategic sectors, and nurtured domestic champions, those signals blurred. China's rise as a manufacturing superpower, its exports multiplying many times over in the first decade of the 21st century, meant that subsidy disputes became routine. US challenges to Chinese wind power equipment grants in 2010 and earlier export subsidy claims show how this system operated as a late-stage arbitration mechanism for industrial policy conflicts. To understand why the WTO now seems stressed, we anchor this story not in presidents or ministers, but in the institutional logic of the WTO itself, its dispute settlement mechanism, DSM, its compliance architecture, and the structural tension between rule enforcement and rule evolution. Picture the WTO as a sprawling network of regulatory arteries that developed under one set of industrial and geopolitical conditions, now being asked to carry the heavier flows of 21st century economic competition. From 1995 to the late 2000s, the DSM operated with a 3-tiered architecture. A panel of experts would decide, and then an appellate body would interpret points of law, creating layered jurisprudence. But rising pressures, particularly from the US, led to repeated blocks to appellate body appointments. By 2020, the appellate body was effectively defunct. The architecture that once provided upward interpretation and institutional memory was no longer functioning. The result was an accumulation of unresolved legal tension. Panels still issue reports, but without a functioning appellate layer, legal interpretations become less authoritative and more contingent. When China brought its challenge to the US clean energy tax credits, it did so into a system where the ability to appeal a panel ruling into a binding appellate interpretation no longer exists. This institutional gap is not incidental. It is a systemic bottleneck that shapes the very leverage of WTO rules. Arbitrators can identify inconsistencies with existing texts, but their decisions rest on a shallow foundation. Without appellate consolidation, rulings are less predictable, and compliance is more voluntary than contractual. In this setting enters the Inflation Reduction Act, IRA, President Biden's 2022 statute that poured billions into renewable energy tax credits and tied certain incentives to domestic content. From a domestic policy perspective, these provisions were instruments to build supply chains for clean technologies within the United States. From the WTO's viewpoint, provisions that condition benefits on domestic inputs resemble import substitution subsidies, historically a classic prohibition under the SCM agreement's red light category. So here's the paradox. A law designed to accelerate decarbonization, a global public good, became legally suspect under a trade treaty whose rules were not drafted with 21st century green industrial policy in mind. This is not merely an irony of content. It reveals a systemic mismatch between the pace of industrial transformation and the static architecture of subsidy disciplines. When the WTO was designed, many industrial policy tools were already in place, but the scale and strategic priority of clean energy infrastructure were not. The stepwise mechanism here is instructive. First comes accumulation. Over decades, states have built industrial subsidies as a core lever of strategic competition. These subsidies are not neutral market supports, they are nodes in supply chain architecture, from rare earth processing to battery gigafactories. China's industrial subsidies in its early wind sector or export performance programs reflect strategic accumulation. Second is entrenchment. Once subsidies fund physical capital, factories, logistics hubs, workforce skills, they create path dependence. A subsidy for domestic components becomes not just a financial incentive, but part of the logistical arteries that knit together a region's industrial ecosystem. Third comes leverage. When such subsidies distort the terms of trade, they become actionable under WTO rules. But leverage in the WTO context is asymmetric. A complaining state must persuade a panel that a measure is inconsistent with agreed disciplines and then hope the losing state complies. With the appellate layer absent, the leverage tension becomes more about political negotiation than legal adjudication. The recent WTO panel ruling against the IRA subsidies is a case in point. It recommends that the provisions be withdrawn by October 2026. That timeline is more than a deadline. It is a structural pressure point. It intersects with state budgeting cycles, corporate investment decisions, and the physical timelines of energy infrastructure build-outs. To put this in broader historical pattern, consider how the WTO's subsidy rules have confronted deep industrial policy before. The Brazil-United States cotton dispute in the early 2000s forced Washington to revisit decades of agricultural support. Similarly, the rare earth trade dispute in the 2010s touched scarce critical minerals and export restrictions. In each case, the WTO's legal regime imposed constraints on domestic subsidy architectures, but often only after long battles and partial compliance. Today's clean energy subsidy dispute is part of the same pattern, but the infrastructure involved is larger, more globalized, and more consequential for multiple economies. Clean energy supply chains span continents. Lithium mines in Australia and South America feed battery plants in China and Europe. Silicon for solar cells travels through East Asian networks. EV assembly lines traverse North American logistics corridors. Subsidies twist these arteries. They redirect flows, create redundancies, and sometimes erect barriers. The WTO's current structural tension is that its rules were designed for a world where tariff elimination and quantitative discipline on goods were the priority. The green industrial era demands rules that can distinguish between legitimate environmental policy and protectionist distortion. Without updated disciplines or a functioning appellate layer, the WTO becomes a mirror of systemic inertia. Disputes expose fractures but seldom resolve them decisively. This leads to patterns repeating across sectors and regions. China is not the only actor challenging subsidy regimes. It has recently initiated complaints against Indian EV incentives as well. The European Union has raised concerns about US clean energy incentives. And the WTO debates about modernizing industrial policy rules continue. The quiet consequences of this structural tension are manifold. First, states may retreat toward bilateral or plurilateral arrangements outside the WTO, eroding the centrality of the multilateral system. Second, investors face legal uncertainty. Capital for a new plant may be stranded if trade rules force a subsidies withdrawal years later. Third, policymaking becomes more circumscribed. Countries may self-censor industrial policy to avoid costly disputes. These are not dramatic disasters, but they are leverage points of constraint. One consequence is that state strategy becomes reactive, constrained by what the treaty texts allow rather than proactive in building resilient industrial networks. Countries with deep pockets and diversified markets can absorb these constraints. Smaller or emerging economies may find themselves squeezed, unable to use industrial subsidies to climb the value chain without triggering complaints. At the same time, a deeper question lingers unresolved. Can the WTO evolve its subsidy disciplines to better reflect the needs of a decarbonizing world without fostering protectionism? This question sits at the intersection of legal architecture, economic strategy, and geopolitical competition. In this sense, the US-China clean energy subsidy dispute is more than a contest over tax credits. It is a systemic stress test of the WTO's institutional architecture. It reveals the hidden pressures in the arteries of global trade governance, the choke points where legal interpretation meets political will, and the growing gap between static rules and dynamic industrial competition. As the world transitions to new energy systems over the next decade, these structural tensions will continue to shape policy choices, supply chains, and the very nature of international economic cooperation. The unresolved question, how to reconcile deep industrial policy with multilateral disciplines, remains open, echoing through corridors in Geneva, boardrooms in Shanghai and Washington, and factories in emerging industrial hubs across the globe.